All right, so today we're talking about how your credit is impacted by your income. And a lot of the times you may be told, like, no, your income does not affect your credit. And while that may be true in a literal sense, it is not if you understand the inner workings of credit and how credit works and, what all you need to be able to get finance for different deals and in order to be able to build your credit. So the first things first, the majority of companies that are going to lend to you, the majority of companies that are going to offer you credit or credit cards, loans, whatever it may be, whether it's revolving or installment credit, they're going to want to see some form of income from you. So if you have absolutely no income, in a lot of cases, it's virtually impossible to get funding from certain companies. So, though your income may not directly impact your credit score, it will impact your ability to obtain credit. Now, there are certain companies in which you can get certain secured products with, or you can get certain, credit builder products that they're not going to ask you for an income. Um, and with that being the case, you can, of course, get around it that way. There are certain companies that will ask you for projected income if you're dealing with business credit or things to that nature, and they may loan to you based off of projections. So once again, when you're looking at those different types of things, there are opportunities for you to get funded those ways without necessarily having an income. But let's move a little bit deeper into it. So now let's say for whatever reason you're able to get around it and you are able to get funding without having an income. Now you have to think about your ability to actually repay that debt. So if you go and you get $1 million loan on a property and you're expecting a certain amount of cash flow off of it, and then that property actually ends up not cash flowing and it starts costing you money. Now at that point, what are you going to do, or what funds do you have available to cover the debt? A lot of the times when you look at a real estate deal, you may look at a real estate deal or a certain business deal and you might say, hey, this looks like a really good deal. It's going to cash flow. I'm going to make money instantly. Let me jump into it. And then the minute that you get the property or you get the business, the narrative changes. And now all of a sudden you can't repay that debt. Now, once again, on applications, when you're applying for credit, they're going to be asking you for your income because they're trying to help you figure out if you're going to be able to repay that debt. And they have calculations for, in the event of something going wrong, would you still be able to afford to pay that debt? And so that's something that you definitely want to look out for. Now, moving a little bit further ahead, another way that your income is going to affect your credit score is going to be your debt to income ratio. Now, of course, your debt to income ratio is not a factor in your credit score, but it is when you're going for financing, especially when you're making large purchases. If you want to purchase any type of real estate, cars, anything in that realm, they're going to want to see a debt to income ratio, and they're going to want to know that you can afford to repay them. If you show them that you can't repay them with your debt to income ratio, more than likely they are not going to fund you in that deal. So it's extremely important that you pay attention to that and you allot yourself the appropriate income in order to have a good debt to income ratio to be able to obtain the things that you would want to get with your credit. Now, number 4, going in a little bit deeper, your credit limit determination, right? So this was the 4th talking point that I had today, where we're talking about how your income is going to affect your credit limits. A lot of people don't realize this. You wonder why you apply for credit cards and you always get lower limits than your friends or than the YouTubers that you see, or different people applying for the same cards. A portion of that and a factor of that is your income. Based upon your income, banks will determine your credit limit. So if person A makes $40,000 a year and person B makes $100,000 a year, I should be able to lend more money to person B without risk than person A in general circumstances. So creditors are going to look for these things in any financial institution that's funding you and say, hey, well, person B has, say you have the same amount of debts and everything else, your debt to income ratio is going to be half of that of person A, less than half of that of person A. So it's extremely important that you look at that and you're aware of that when you're determining what cards to apply for, just as well as when you're applying for cards, realizing that your income is a factor. And last but not least, because of financial stability, it's extremely important that you think about financial stability and in the long term, you being able to repay that debt and how it's going to affect your life. And so it's extremely important that you have a steady and sufficient income that can give your lenders the confidence to say that you'll be able to repay whatever debt you have out. So, as always, thank you all for watching. Thank you all for tuning in, and we will see you in the next video.